Cool. All right. Well, I think we have a good critical mass here, and I think we've done a good poll for how much people like taxes. So I'm going to kick us off. Hello, everybody. I'm Daniel. I'm the founder of Startup CPG, and I love to host a lot of these topics. And I specifically asked the team if I could host this one because it is tax season. And for whatever reason, I still personally do a lot of our reports and filings and get ready to do the taxes. And I was just telling Alice and Eric, probably I need their help because I'm not doing a very good job of it. So I wanted to host the webinar so I could learn along with all of you guys. So without further ado, let's get into it. And I'm really excited because I know we're going to be talking about financial statements, not just for tax filing, although, we're getting to that time, but, how do you do your financial statements for investors and then also for taxes? So two different use cases here. And we will send around the webinar recording and the deck afterwards in an email, just so in case you don't want to take copious notes. So Alice, Eric, do you guys want to take it away? Maybe you could start by introducing yourselves.
Sure, sounds good. I will start. So hi, everyone. Thanks for joining. I'm super excited to be here. I'm Alice. I'm co-founder, one of the co-founders of Pocket. We're rebranding, and the full name is called myPocketCFO. So me and Eric, we founded Pocket with the mission to make accounting and finance so much easier for CPG founders, because we know we're not the best at CPG. There are so many amazing CPG founders out there, but we're really passionate about accounting and finance, so we think we can help. And that's why we're here. I'll pass it to Eric. And a little bit my background, I've been CFO, started with McKinsey, FP&A, financial planning and analysis, CFO for many years, both for high-tech tech companies as well as for CPG companies. Eric?
Yeah, thanks, Alice. So I'm Eric, co-founder of myPocketCFO, or Pocket, along with Alice. I am a CPA by trade. And so as we were joking before, most of the people were on the line, I actually enjoy this accounting stuff, unlike probably most of the folks on the line here. And so with our product, my focus has been just to make sure that the accounting flows are happening in the tool and the system as designed. And whenever we have any specific complex accounting issues or questions from many of our customers, I always chime in with my thoughts. I've worked in corporate accounting. I've been controller. Anywhere from kind of bookkeeper all the way up to controller for small businesses, large multinationals as well, in various accounting functions. And so, yeah, I'm, this topic really excites me. So I'm happy to be here talking with you guys, and happy to answer any questions along the way. So Alice, I'll pass it back to you.
Just as we're jumping in, I just dropped a link in the chat. So the myPocketCFO team is kind enough they've offered up just kind of one-on-one sessions. If you want to just chew their ear for a bit on something that you guys are dealing with, or if you want to ask for advice or just kind of get a consultation, the link is in there. You can sign up. It's free. You'll see, be very happy just to chat with you a little bit and understand what's going on with you. So thank you guys for that. And just click on the chat and then also submit Q&A as we go along as well. Alice, to you.
Thank you, Daniel. By the way, there's a QR code. You see that on the lower right? So if you scan that QR code, it's the same link. It will link you to the same one-on-one session. We would love to chat with you if you have more one-on-one private questions to ask us. All right, I'm gonna take it away. As you know, Daniel, as you mentioned, there are two use cases here. We're talking about financial statements or preparing financial statements for two distinct use cases. One is for investors, the other is for tax filing. I'm gonna do a survey with the audience or crowdsourcing. Please just type, I would say in the chat, in your opinion, what are the differences between financial statements for investor versus for tax filing? I kind of want to understand what our audience is thinking before we reveal our perspective? Anyone would want to start typing? Or you can say, I don't know. All right, forecasting versus historical. Yes, that's pretty good answer. Inflate revenue for investor, deflate for government.
I'm a CPA. I didn't see that one. I closed my eyes.
Somebody, I think they didn't send it to the whole channel, but
good one, but good one, just good one.
Somebody said inflate the revenue for investors and deflate it for the government, but they said it was a joke. That's a good one.
Okay, I give a thumbs up for the joke. Okay, for investor, you want to look like you're making money. For taxes, you want to make it look like you're not making. Oh my gosh, our audience is so smart. I love it. I love the audience. Okay, cool. Okay.
If anyone here works for the IRS, please leave.
Right, or just blind
Close
your
eyes.
eyes.
Yeah.
Close your eyes. Okay. All right. Let's review our answer or the pocket perspective, right? Okay. Next slide. Okay. Sorry. Next slide. Okay, so from more professional perspective, here are our answers. The main difference would be for investors, we would always want to prepare a accrual-based book, accrual-based P&L, accrual-based balance sheet. And what does that mean? When we say accrual-based, this is in contrast to cash-based. So I put cash-based. For tax filing purpose, I would say typically and Pocket, we recommend you to use cash-based to file tax. And for investor and for management purpose, we recommend you to maintain a accrual-based book. So that's I would say professional answer from us. What's the difference between accrual-based and cash-based? Mainly, I would say accrual-based accounts both on the revenue side as well as on the expense side for something that accrued but may not involve a cash transaction. Like if you issue invoice to Whole Foods or Costco, which they may not pay you until 3 months later, but that's a big order, right? So under accrual based, you count that as revenue. So that's recognized revenue as soon as you issue that invoice. That could be hundreds, like 100K, couple 100K, couple millions of revenue. In cash based, actually they're not because they're accrual based. On the expense side, if someone issues you a bill, right? If some like a 3PL issues you a bill, you enter into your book, accrual-based book, as expense accrued, even before you pay the 3PL the cash. If your I would say co-packer, your manufacturer, or your inventory holder issue you a bill that you owe them, or you're like a raw material vendor, right? You owe them, but you may not have paid the full cash to them. You may only pay the down payment. In that case, on the accrual book, you record the full bill they issued to you as accrued expense. So that's accrual. In cash-based, for basically revenue, if it's accrual based, you don't record that as revenue. Expense, if you start paying, you record that as expense. And we're gonna go into deeper. I think Eric is gonna talk more about. And going back to some of the comments earlier, cash-based, sometimes it does reflect more expenses. If you, for example, if you spend cash upfront to buy inventory, if you spend cash to co-packers, those things, on the accrual-based book, it may be recorded as an asset, like as inventory, but on the cash base, it will be recorded as expense. So the net effect is it may boost up your expense and may record less revenue, which would generate the results to some founders as desired results, right?
So the reason for this, like with the example that you gave, okay, let's say you're going through a distributor, UNFI, KeHE, and they've ordered, but they haven't given you the money yet. Like an investor would actually want to know that. It could be a big order. They want to know, like, really, where's your business at? So that would be kind of the main reason for that. Whereas the government doesn't care. They just want to know when you have the money so you can pay them. And like, you know, the money doesn't lie. They don't want to know your expectation for what amount of deduction you might get possibly in the future. They just want to know, like, did you get the money? Okay, you owe us this much. Is that a fair?
Exactly.
Yeah.
Exactly. And to your point, Daniel, I put it here, accrual based, you know, not only because it's GAAP accepted, which is what investor is looking for. The fundamental reason is that it's very much tied to value creation or valuation of a company. And if you think in terms of like a public market, what is value? How do you measure their value, right? It is like in a very, you know, again, very geeky financial way to say that it's accumulated return over like indefinitely into the future of this business, right? So that's how we have actually very concrete formula to calculate the value, but the value is kind of like estimated, the estimated accumulated return of your business going indefinitely into the future. So that in nature, that goes with the public market valuation method. And that's why for managerial purpose, you want to use accrual based. Okay, all right. If no questions, I'm gonna move to the next slide.
Well,
Sounds
maybe
good.
just one question, which is, what about like assets? Okay, if you buy a piece of equipment, how is that going to be different? Because if you're like like I know when you're filing taxes, sometimes you would depreciate it over time, right? Which is not necessarily cash based. So is that different for one versus the other?
Yeah,
I would leave that to Eric. You
yeah,
wanna?
yeah, there are, and I'll get into that a little bit here on subsequent side, but there are certain types of assets and liabilities that you would actually report under cash basis as expenses, but there are others that wouldn't actually have any difference or much of a difference. Assets like fixed assets, machinery, equipment, you know, kitchen equipment, that kind of stuff. You can still have that on your balance sheet. And the corresponding depreciation for those for that equipment is still an expense. So there are some things that actually wouldn't really make too much of a difference between cash versus accrual. It would, you know, it would stay on your income statement and balance sheet. But there are some differences for cash versus accrual, which we'll get into subsequently.
Awesome.
All right.
All right. Let me move. So let's talk about financial statement for investors first, and then we'll get into financial statement for tax filing. And the sequence, we're doing this sequence is based on the perspective that, as I mentioned, as a business, we recommend you keep a month-to-month, meaning a day-to-day running book using the accrual based, because that's going to give you a lot of operational insight. That also is going to, I would say, required by like lenders, be required by investors. When it comes to tax filing, I would say activity, typically once a year, right? Then we have ways that we could share with you. We could advise you to basically convert the accrual base into cash base, because we do think the main purpose of that is to file tax. All right. So next, let me get into, this is a very busy slide. I apologize. Design financial statement. So when we talk about financial statement for investors, I would say, if you think about, let's just use P&L, income statement, as an example, right? So from very left, I'm showing a very high level structure of an income statement. So on the income statement reflects your operation health of a company. Typically, what you want to report in the income statement, obviously, is the total income. Sometimes we call it revenue, total revenue, and then total cost of goods sold, or basically cost of service, right? Or cost of goods. And then income minus cost of goods sold, then it's your gross profit. After that is basically we call below the line, and I typically call operating expenses. So all the other expenses, sales, marketing, your payroll, your equipment, machine, your the rent, the travel, all those goes into this category called total expense. And I oftentimes like to call it operating expense. Basically, they are expenses related to the business operations, right? And then gross profit minus total expense, that's your net operating profit, right? So that's very high level. We also listed total other income, total other expenses. Typically, they fall into the category of I call non-operating income and non-operating expense, meaning something like you get a loan. For example, we typically think of them as financial activities, not part of the operating activities. So in that case, there might be some miscellaneous. You get a grant, for example. We typically put those as miscellaneous income under other income. So does like the interest you pay, we typically put them under other expenses. And then after you extract basically your net operating profit times other income minus other expenses, then we get your net profit. That will be a very, very high level P&L, right? So if we blow that P&L up, you can see here where like this is Pocket methodologies. We would love to work with our clients at the very start, meaning when they're onboarded, we would love to design a blow up income statement. And this is an example of a blow up income statement. And the way to design a blow up, I think the way to start the building block is a term called chart of accounts. I believe many of you have heard of the name many times, right? This would be your accounting category that for each and every transaction of your business, you need to categorize one of those account to associate with each and every transaction of your business. So you can see that total income can be blown up into sales by channel, right? And then total cost of goods sold can be blown up into cost of goods sold by channel. And I put some key metrics here. If you blow, like we typically work with our clients to blow it up based on their like the type of channels they want to track. And once we define those, I would say sales by channel, cost of goods by goods sold by channel, we can basically can have a pretty good insight into gross profit by channel. Typically, I would say for CPG, you would at least want to differentiate DTC channel because the gross profit of DTC might be different. It is quite different from gross profit from your offline, meaning your wholesale and a retail channel, right? And then further, you can blow up the operating expense into this category, sales expense and advertising and marketing. We call them sales related. And a large portion of this expense are variable cost, meaning they vary based on the units of your sales. So this is a very, very important metric you want to blow up properly so you can track the variable cost either as a whole, or you can track the variable, meaning sale cost by channel as well. Like you can track trade spend specifically to your offline, your wholesale and retail channel, you could track a web ads specifically to your DTC channel. So anyway, this is another area I personally am very excited and fascinated about designing the right selling cost with our customers. So and then if you design this right, I would say your gross profit minus the variable cost of your selling expense will give you insight about your contribution margin, right? For many of you, like we can talk, I could talk like for a day about contribution margin. But anyway, contribution margin really tells a business after, after cost of goods sold and after sales expense, how much money you left on the table that you can pay for fixed costs, meaning you can pay your employees, can pay your rent, you can pay any other, costs that are not directly associated with your sales.
And one
Anyway.
question that came in is, what about freight and 3PL fulfillment kind of stuff? Would that be COGS or selling expenses?
That's a great question. In short, there's freight in, there's freight out. We typically consider freight in, meaning freight from your co-packer to your warehouse, as part of cost of goods sold, as part of the inventory, and freight out, meaning from your warehouse to customer's door, as operating cost. Does that answer your question?
Yeah, great.
Okay, cool. So I think that's just in a nutshell. And then once you have your contribution margin, it's very straightforward for you to calculate your break-even point. If your goal, for example, especially under today's environment, is to break even as a CPG company, you could also, I think the contribution margin could also influence your pricing decision, because it's also very valuable for unit economic analysis, because contribution margin measures the unit level cost and margin. Okay, so let me can I unshare this? Sorry, let me just shrink that. And I want to just do a very quick demo. This is how so we're launching this new app. This is how in our app, just to give you a glimpse, this is a fictitious company called Snackero. So basically, this is a fictitious chart of accounts, but the chart of accounts look exactly like how your P&L would look like. And that's where, when we engage with you, we discuss what are the sales channel you want to track, and what are the cost of goods channel you want to track. For example, like I just added specialty foods. If a client, I know like Ash, you're here, you're my first client, we just talk about, like if I want to add, sales of product income. I don't know, Ash, are you there? Maybe I know you just launched into some new channel that you want to track, right? Did you reply?
She sent in the
Fair,
chat.
Amazon,
Fair,
right?
Amazon,
So
food services.
if you want to add Fair, I know Fair is a very popular B2B channel. Many of you, so we could literally just add a Fair channel, and then we would add corresponding cost of goods sold for Fair as well. So anyway, this is just a very small demo to show you how basically we work with the brand owner to design your P&L. Okay, let me go back to the slide. Anyway, so this is just a case study. We would do the same for balance sheet for our clients. Balance sheet, we would talk about what are the chart of accounts you want to track for your inventory. Accounts receivable and accounts payable, they're important on the accrual base, as I mentioned. Accounts payable, we would like to sit down with our customer to identify key vendors, especially if you plan to issue 1099 and year end. Then we would advise you to set up vendor specific accounts payable. And then so you can track and maintain bills issued by those, let's say, independent contractors or agencies. So we have a way to reconcile the payments to those bills, and we have a way to track your spending on them. And then by the end of the year, during tax filing, you know what's the amount you're gonna put on the 1099.
Can you go into presentation mode again?
Sure.
Thanks.
All right, any questions? I saw some chance there. Oh, okay. Got it. All right. I would say similar with loan and save. We do recommend you like in the chart of accounts, you go by specific vendor name. Save, obviously you could use some other like a cap table management tool to maintain the individual save writers. You could use that, and typically on your I would say on your financial statement, we don't recommend you to reveal the specific save person's name. So we'll just lump all of them into one safe under equity for you. For loans, we do recommend typically CPG businesses, you have a portfolio of lenders. We recommend you to track the loan and payment interest as well as principal payment one by one by vendor. So we can basically design the chart of accounts specifically on those accounts, those categories. Questions, comments? If not, I'm gonna pass the floor to Eric to talk about tax filing.
Sure, thank you, Alice. And this, Daniel, gets back to your question. So what trips people up the most is actually the explanation that you may have two sets of books, right? You have your accrual basis books for your accounting, for your reporting. That's what you're looking at on a daily, weekly, monthly basis. But then your tax preparer may have a different set of books, which are your cash basis books that they use for preparing and filing your taxes. And those books may actually have a different net income number at the end of the day. You know, what you are reporting to your investors, your accrual basis books, that net income may be different than what's filed to the IRS for the net income of your business under cash basis. We're actually in our product, we're working on a feature. It's basically a toggle switch between accrual and cash that you can kind of switch from one to the other just to see, you know, the impact. And the accrual being for your investors for your own purposes, and then the cash being a cash basis being for what's used for your tax preparer. And then the question is, what's the difference between the two? How do you convert accrual basis to cash basis? We've highlighted here three of the key aspects that would probably resonate the most with you in terms of accounts payable, accounts receivable, and inventory and COGS. So your accrual basis books, if you've probably heard the terms accounts payable and accounts receivable, you would have accounts payable and accounts receivable on your books. Accounts payable are bills that you have received, but you haven't paid them yet. And so by December 31st, for example, you have accounts payable on your books. You still have some bills to pay. Similar with accounts receivable, you sent your customers invoices maybe on December 31st, but they may not pay them until January, hopefully, and hopefully not into February, but they won't pay them until some other time. And on cash basis books, both of those get zeroed out. There's no such thing as accounts payable and accounts receivable on your cash basis books. And that's because when your books are cash basis for tax purposes, the government only cares about what you got paid in cash by the end of the year. And so if you have a bill on your books as of December 31st on accrual basis, the government doesn't really care. They want to know, well, what did you actually get paid? And so there are adjustments that you have to do to zero out that accounts payable on your accrual books, and how does that impact your cash books? Similarly for accounts receivable, the government will want to know that what you actually received in cash from your customers, and that is what's counted as income. And the third one that's highlighted there is inventory to COGS. So it's a very similar concept. In the month of December, or towards the end of December, maybe you paid for a large purchase from your co-packer. It could have been $100,000, and so you may have $100,000 of inventory on your books, on your accrual basis books. And that's an asset on your balance sheet. It hasn't gotten expensed yet. But for a cash basis, since you paid that $100,000 in December, that's actually an expense that goes directly to COGS. It's a COGS expense on your books. So your accrual basis books may have an asset account called inventory, but your cash basis books would not have inventory, and it would just all be expensed as COGS when you make that payment. There are a couple other examples here that are maybe a little bit less relevant with accrued revenues, accrued expenses, prepaid expenses, but it's the same concept. There are certain accounts that you would actually want to convert from accrual to cash basis, and that'll impact the income and expenses that are reported for your cash basis books for your taxes. Okay, so I will pass it back
I
to
would
Alice.
chime in to say when we have close to 100 clients. When I would say 90% of the clients, when we onboarded them, they were using cash based, and their COGS were just superbly high, which makes their gross margin from accrual based perspective negative margin. So imagine if you record all the money you spend on inventory as cost of goods sold in 1 month, or like every quarter you spend a huge amount to your co-packer. In accrual base, it should be captured as asset under inventory. But in cash based, they will be captured as COGS, which will make you make your gross margin negative, which would look very messy in investors' eyes. That's why we say, hey, if you want a managerial accounting book, which we recommend, yeah, let's switch to accrual based, right? So we would record properly inventory as inventory spend, and COGS only we would incur or calculate your cost of goods sold only as proportionate to the units you sold when you ship it out. So that's another example. But it's beneficial to you, like if you spend a lot of money purchasing inventory, and end of the year you can file all those as expenses to IRS, so you don't you get tax benefit basically.
Right. It basically accelerates that expense and accelerates that tax benefit in the current year, as opposed to the next year or subsequent years.
Okay. I know there's a question. Sorry. I know there's a question asked in the chat. Do you have any opinion on let me see if I
They're asking about LLC versus C Corp. Like, what's it better to launch as based on tax benefits, or what investors prefer?
I'm gonna provide my input. I'm not tax expert, but we do have our tax partner, Wenda, here. I believe you're in the crowd. If you want to chime in by typing in the chat, please feel free to do so, Wenda. I don't know if you're there, but I would say, given our own experience, we I think you're right, MP, for lack of knowing your name. You're right. Basically, yes, in some circumstances, LLC to begin with would save you some administration cost, such as tax filing. But if you plan to raise equity money from institutional VC, then typically they would require you to convert LLC into a C Corp. I would even go further by saying this is very common. You know, a lot of bootstrapping companies, you start as LLC, and then only when you get a term sheet or when you're pretty close to getting funded by a institutional VC, then you convert at that time. And the typical conversion fee from a good law firm, I would say 3 to 5K. I would even go. There might be lawyers here in the crowd, but anyway, don't blame me for quoting a number there, but that's my experience. Yeah. Wenda, if you wanna chime in with additional insights, feel free. But you're right, it doesn't matter for safes, but it does matter if you're talking to an institutional VC. And by no means you could launch as LLC and then convert it whenever you're ready to accept institutional VC funds.
Yeah, we see a lot of our customers that come to us either as LLCs or newly converted LLCs to C Corps, as they're in that kind of fundraising timeline where they know they need to fundraise, and most likely their investors are telling them the same thing, like, okay, well, incorporate as a C Corp and then come back to me.
Yeah, yeah. And in terms of tax filing for LLC, I think Wenda is typing, yeah, he's saying LLC or partnership is pass-through entity. So which means the entity itself does not pay tax. Instead, the owner will pick up the income loss on individual tax return. C Corp is a tax entity. So we have to file like a separate C Corp tax forms. That's my understanding. Wenda, correct me if I'm wrong. So I think, yeah, the short answer is yes. Like especially if you file a partnership LLC, you could probably take care of the tax filing by just file your personal income tax. But if it's C Corp, you have to take care of the tax filing separately.
Okay, great.
Okay, awesome, cool. All right, if no other question, Wenda is saying LLC and partnership does file tax rate. Okay, anyway, yeah, so you do still need to file a form 1065. Okay, cool. Anyway, I think that's financial statements for investors and tax filing. I'm gonna click that. The key, I think, if the audience, you wanna have key takeaways, there are 3 key takeaways, I would say. Number 1, we strongly recommend for any CPG brands here, as a business, you should adopt a accrual-based accounting method as a default, even when you are very small. So whether you hire accountant or use some accounting agencies, please make that explicit request that they, or if you use us, that's great, but please make that explicit request. They should do accrual-based accounting for you. And then I would say, when it comes to tax filing, we recommend you use always convert that accrual-based to cash-based. I think many tax accountant, they would offer that service, but as CPG founders, make explicit requests that they convert the accrual-based book to be a cash-based book to file your tax. And then in addition to that, again, we would love to design your chart of accounts upfront. I believe that's going to be very, very insightful and useful for your managerial book and to review. insights and track your key operating matrix. Especially when you're small, you probably want to, you want accelerated growth. And when you're small, you experiment on a few channels, on a few, categories of product. You really want to closely track and identify the ones like I always call the one channel or one skill that gives you the biggest return per buck. So we would love to discuss with you on how to design the channels, both on the sales side as well on the cost, especially cost of goods sold, as well as selling cost, the variable cost, to design that. So hopefully it will reveal a lot of insights for you.
Alice, when if we use like a Brex card, for example, or a credit card or something, and if we import our history, a lot of times it'll come with their own categorization of what the spend is. And if a business is like spending on a lot of things, like I don't know, at a small company, nobody necessarily wants to go through and like really specifically categorize every single thing, maybe just accept those buckets. Like is it hard for people to try to map those into the chart of accounts, like the specific categories, if there are new buckets, or there are easy ways to do that where you don't have to like kind of lose your mind reviewing every single entry and trying to get everything perfect?
That's a great question. I would use that as a plugin. We basically, our methodology is we design, like we partner with founders to design your chart of accounts. And once it's designed, we have we call mapping rules page. That's where we map the chart of accounts to all your vendors. We have an AI component which does it automatically. Many of our customers use Brex, and actually, I'm not associated with Brex, but I would review a stat from our existing customer base, which is a surprise to me, is Brex ranks as top 3 bank of small CPG brands. Obviously now, like first is like the big ones, traditional ones like Chase, Bank of America, but Brex is actually similar with them in terms of the choice. So I think with that being said, I know Brex has its own category. When we pull from Brex transactions, our AI component automatically convert their category to your specific personalized company specific chart of accounts. So we do that conversion. And then so when you see your P&L, it's your specific chart of accounts. And
So
the way, yeah, go ahead.
two questions that came in. One is somebody asked, what's your guys' fee to develop a chart of accounts? And probably they would like to know just generally how much you guys charge overall anyways.
We charge incredibly low.
Okay. Well, let us whatever you can tell people. And then the second question someone else asked is, well, isn't there like a generally recommended chart of accounts for an e-commerce product business, or does it always have to be customized?
Great question. First one, I think for the basic accounting tier, we charge 200 subscription fee per month. So it's probably very low than you hire any accountant to do that manually. So that's our fee to do your accounting on a month-by-month basis. Second question, is there a recommended chart of account? Yes. So when you onboard with us, we do load up a recommended CPG chart of accounts. Whatever I showed to you just now, maybe I could just go back there. This is our, I'm using a fictitious company. It's in our QA mode, sorry. But anyway, let me go back. But so we load up a standard, and our standard is based on the commerce platforms you connected with. So if you're connected with Amazon, we automatically generate a sales cost of goods sold by Amazon. If you're connected with Shopify, we automatically generate. So we typically, we just automatically go with the type of commerce platform you use. For the offline, I would say for offline, like wholesaler retailers, because you issue invoices, we can't really tell from the back end systematically. That's where we come in, sit down with you during onboarding, typically in the first week of the engagement. We basically, we send out a survey. We also sit down with you based on your survey answers. We recommend you to, create a personalized chart of account, say, whether it's Whole Foods or Costco, if you want to track.
So that 200 fee, that includes like like filing the taxes as well, like so it's a monthly subscription, and then is there an additional fee to file taxes, or is that included?
That's another good question. The 200 fee covers the basic month-over-month bookkeeping, plus a CPA review on a monthly basis to make sure your book is reconciled. When I say reconcile, it means it matches with your bank statement, and we're sure that it's at least from cash inflow outflow perspective, it's accurate. So that's that covers that. If you want to do tax filing with us, we charge a one-time fee of $1,500. We file basically your federal income tax of the business, and we file your resident state, whatever state you resides or you register the business resident state income tax as well. So that's once a year. It's one fee. We do the conversion from accrual to cash-based. CPA review, Eric will review that. We work with our partner, Wenda is here. He's a tax partner, used to be tax partner from PwC. So he will actually represent you, do your tax filing. That's $1,500 one time. And then, we do have a strategic tier. It's $500 per month. If you want to engage in more, I would say, strategic finance discussion, such as forecasting, such as I want to improve my gross margin, contribution margin, or profitability, then you can upgrade. And anytime you can upgrade just for 1 month, that's where I comes in. I talk to you more about strategic finance matters, as well as, I would say, fundraising, both for equity fundraising as well as for borrowing, alternative financing. Are you seeing something, Daniel?
Nope.
Cool. Okay. Does that answer the question?
Yes.
Okay, cool. All right. Any other new questions coming in? There's one more.
Yes.
Go ahead, Daniel.
Yeah, where do you categorize discounts in the chart of accounts? Like, trade promos, off invoice discounts, direct to consumer discounts on Shopify. And how important is it to do that by channel?
Okay. Very good question. There are two types of discounts. One type we call counter income. Something like I know is very popular name, chargeback. I'm sure many CPG founders are familiar, right? Many of the chargebacks, we could categorize them as a counter income category, which would go under the income category, but the number would just be a negative to go counter income, like discounts, for example, refunds, they would go into counter income category. The other type of category, for example, Amazon fee, Shopify fee, we recommend you categorize. It's part of our recommended standard CPG chart of accounts. We would actually load it up for you upfront. We would load them up in the operating expense category, just so you know, because from our perspective, they are below the line. They are part of selling expense. So we would call them Amazon platform fee, and they will be under the operating expense. So if you want more specific questions, come to talk to me and Eric, we can help you design. So, but again, they could go either as a counter income category or as an operating expense category.
And then there's another question about like doing income, like income tax filing services. I think that means like more from a personal standpoint. Like you can do the business tax, but then a lot of us have to do our personal taxes, especially if like, you're the owner of the company or, just a couple people, you might be responsible for this, but also filing your own income taxes. Do you guys do that also? And if so, the fee?
I would defer that question to Wenda. He is really our tax partner. I think if it's C Corp, we would only do C Corp because there's a distinct difference between business tax filing
Oh, okay.
and personal tax filing, right? If it's LLC, there are also two types of LLC per my understanding. One type is partnership, which they combine together. The other type is LLC needs to file as a business. I think in principle, because we prefer to do your business book and our specialty is your business book. We prefer to file your business tax. But when it comes to a specific case and your specific company formation type, you can come to talk to us, basically, Wenda specifically.
Okay, cool. I might just say if there are more questions on that topic, I would encourage you guys to use the link in the chat and schedule a one-on-one session with Alice and Eric and Wenda. Probably you can go a lot deeper and they're happy to chat with you guys.
Exactly. Is there another? I saw a few, there are two open questions. Is a recommended chart of account source you can recommend for common business types such as SaaS and the e-commerce product business? Yes, so if you sign up with us, we do have different sets of standard chart of accounts. We have one set for CPG business and another set for SaaS and another set for service, actually. Okay. And
and those accounts could be different across industry, basically. Like a CPG chart of accounts is not going to be the same as a services company or a SaaS company.
okay, so one more question. Would myPocketCFO monthly base fee allow for an instant conversion from accrual-based books to cash-based books by the push of a button so tax filing can be done on one's own? That's a great question. It's a new feature we're developing. I tend to say yes, Eric.
I'm that's
always for the
concept.
CPG founders.
Yeah, I mean that's the ultimate concept is you don't.
We want to automate it for you.
Yeah, so the idea is that you could, in essence, click the button to get a cash basis books. So you could take those books and have your tax. It's like if you've been working for a tax preparer with a tax preparer, you can have them prepare your taxes for you.
Yes. With that being said, I would say if you are really small bootstrapping, yes, you should utilize features like this and do your own tax filing. When you grow bigger, especially when you have institutional investors, I do recommend you work with I would say, certified tax accountant like Wenda, because they're gonna file it for you, represent you, especially when it comes to audit. Like if the IRS comes back to you, I think that's, even though it's a little bit more premium, but it's really, I treat it like an insurance, basically risk protection insurance for your business. But when you're small and bootstrapping, yes, by all means, take advantage of the automation. Any other questions? We've got 2 or 3 minutes. Otherwise, again, always use the link. Daniel put it up there. We're always happy to chat with you about specific questions you or your business might have. Again, our service, we have a basic accounting function, which is very automated with our new launch of the Pocket product. With that, our goal is to, again, save the founder's time, 80–90% of the time, of your chore work. And then, so you can work on more growth and product and marketing and sales. But we do want to make it more of a one-stop shop. So it saves you time. So you have to go out. If you need access to CFO, you can access to me. We do have a higher pricing tier. If you do need tax filing, you can use our platform to file tax for you as well. So that's our goal, is we can provide a one-stop service for all your finance needs and very reasonable price.
All right.
Thank you, Daniel, for putting.
Thank you guys for all the questions. Alice, Eric, thank you guys. Yeah, I put the link there. It'll disappear in a sec. But you can always find them on our Slack as well. And my very best wishes to everybody during this tax season. I hope you all have a blast and enjoy it so much that you get to a 10 out of 10 on how much you enjoy taxes.
All right. And
All
if you
right.
don't enjoy it, that's fine. You can find us. We're always
Yeah,
here.
right. All right.
Thank you.
All right. Bye, everyone. Thank you.
Thanks, Daniel.
Thank you. Bye.
Thanks,
Thank
everyone.
you, Daniel. Bye.